Good morning. It is Monday, early here, early Monday, October the 30th, 2023. We hope you had a nice weekend. Gosh, just a beautiful weekend in Charleston. I know Patrick was touching on that as well last week, but just beautiful. Many of you will be excited to know that Keegan had a very strong finish to the soccer season. My daughter, we actually had two games last week, right? One was a makeup game on Tuesday. We were victorious in that game, and then in the season finale this past Saturday, we won again, 2-0. Keegan had just a beautiful goal to end the season. Had it on the left foot, kind of kicked it across to the right, and then just a strong finish across to the other side of the net. Just proud dad, obviously, if you can't tell, but just such a joy to be able to coach her at this age. So really cool. Last week in markets, okay, so we had GDP come in, gross domestic product here in the U.S. Come in better than expected. Okay. Some of the internals maybe not quite as favorable, but headline number better than expected. Earnings, right? We're getting a slew of earnings, which have been mostly okay. Maybe with the exception of Google or Alphabet, the parent company. But this is kind of what you expect at this stage of the economic cycle, right? We're kind of nearing the end of the rate hiking cycle. Okay, and this is where, with the higher cost of capital, right, it's margins can get compressed for companies. You would expect to see the consumer get pinched, although that hasn't happened yet to the extent that we would think it might. But I think volatility is kind of the norm, right, when you get to this stage of the cycle. All right, the longer end of the yield curve has come up a bit as well. Which we went over this in fall reviews, but really it's setting up quite nicely for kind of that short to mid duration fixed income, right? You're gonna have a big tailwind as these bonds, in the coming few years as they come to maturity, given they're all trading at discounts, coming up to their par value. But on that, so you saw that U.S. equity market down a couple percent last week. Now about 10% off of the kind of the midsummer high, right? So S&P down about 10% since the summer, which I guess you would call that correction mode, is the technical term. And when I saw that headline come across the screen last week, it got me thinking back to Morgan Housel's research on corrections, right? 10% corrections. Just a really nice piece of data, that he put out where, he states, for the last 100 years, the U.S. stock market has declined 10% once every 11 months. Okay, so once every 11 months, you'll see the S&P 500, the U.S. market, have a 10% correction, right? And so, he goes on to state, so when you see a so-called, expert come on, whether it's CNBC or Fox Business, and they come on and say, we're forecasting, this 10% correction, in the near term here in the coming year, what they should really say is everything's going to be just normal, right? We expect a normal year where the market goes down 10%. Like it always does at some point in the year. I don't know. I thought that was interesting, and I get it, right? Like we've been over this in the past as well, but the financial media, remember they're doing their job. It's their job to sell advertisement, right? And not give investment advice, tax advice. So I get it. It's just important to anytime you're watching financial media or investment journals, it's really important to just keep that filter. Just know in your head, it's not advice. It's much more for entertainment. And but outside of that, I think, big picture, it's just why it's so important. It's something we really try to emphasize a lot here at the office. Just, you need a plan. You need a plan. Both in terms of the investment portfolio, and that should be working toward your overall retirement plan, right? And that's one reason we really like using the income guardrail strategy, just because inevitably, right, you are going to get those 10% corrections, right? And many times you get longer corrections, more prolonged bear markets, right? And with the guardrail methodology that we implement, right, it's you have that war chest of cash and bonds, 6-7 years, right? Because a bear market could last that long, right? And it's better to, the old saying, prepare for the worst, hope for the best. So we love that. We love that strategy. So we get the jobs report this week, right? So on Friday, we'll get the October employment report. That's always a big news headline. So we'll see the way that shakes out. Again, everyone's just kind of waiting for the employment picture to just start getting just a little bit worse, incrementally worse. We just expect it at this stage of the cycle, but we'll see, because that could have a big influence on whether or not the Fed is completely done or not. So we'll see on that front. The other last thing I wanted to share today. We have this week we'll be sending out our client appreciation invites, right, for the hockey game. I know we included that in the October newsletter as well, but Friday, December 1st and Sunday, December 3rd. Okay, so they didn't have a Saturday game that weekend this year, but Friday and Sunday, so whichever day might work better for you and your family. We would love to see you there. It's always just fun to share, what feels like a lifetime ago now, but hockey was just obviously a huge part of my life and so some other fellas at the office here. So it's just kind of fun to share that with everyone and have a fun night of hockey and food, and as we head into the holiday, the Christmas season. So we wish everyone a wonderful week. Questions, comments, concerns, please don't hesitate to reach out to us, and we'll talk to you soon. Thanks.